What if I told you one of the best performing stocks of the last few years isn't an AI company or chips company, but Walmart? Of course, that wouldn't be true, but is it consistent? Is it safe? Probably. For decades, Walmart was viewed as a slow-growing retail giant. Today, investors see something completely different. An e-commerce platform, an advertising business, a logistics company, and increasingly a technology company. The question is simple. Has Walmart transformed into a premium business? Or is the market simply paying too much for a retail giant? Let's find out. To decide whether buying Walmart is a good idea, let's go through these points. Do you know Walmart well enough? Why would you want to buy them? What are the pros and cons of the stock? And let's run the numbers, my favorite part. To understand Walmart today, you have to go back more than 60 years. The story begins with one man, Sam Walton. Before Walmart existed, Sam Walton ran a small variety store and became obsessed with one strategy. Sell products at a lower price, make smaller profits on each product, but earn more overall by selling higher volumes. At that time, that strategy was not common. Most retailers would focus on maximizing margins. Walton focused on maximizing volumes. In 1962, Walton opened the first Walmart in Rogers, Arkansas. Unlike competition, Walmart didn't start in large cities. Instead, small rural towns were targeted that large retailers ignored. Real estate was cheaper, making it already more cost-efficient as a retailer. At the time, many analysts believed those towns were too small for large discount stores. But Walton did not agree. If customers can save money, they can drive the extra mile. Most people think of Walmart as a grocery store. In reality, it's one of the largest grocery store business on earth by food service sales. The company generates well over $700 billion in annual revenue, operates more than 10,000 stores globally, and serves hundreds of thousands of customers every week. That is a retailer I'm sure most of us know. Historically, Walmart's value came from selling products cheaply at high volumes. Today, the fastest growing parts of the company are much higher margin businesses. Think about e-commerce, marketplace fees, digital advertising, Walmart Plus memberships, fulfillment services. These businesses don't just increase revenue, they improve profitability and diversify revenue streams. That's why investors are starting to value Walmart differently. How Walmart keeps winning. The first advantage is scale. No retailer can match purchasing power of Walmart. Because it buys enormous quantity from suppliers, Walmart can negotiate lower prices than almost anyone else. That creates a pricing advantage that almost no competitor can replicate. Second, its physical stores has become an advantage and not a liability. Instead of competing with the online shopping, Walmart uses stores as fulfillment centers. Thousands of locations mean products are already close to the customers, allowing same-day pickup and delivery in many supermarkets. That significantly lowers shipping costs compared to shipping everything from a centralized warehouse. A centralized purchasing power and a decentralized delivery system. That is doubly efficient. And third, Walmart has become surprisingly competitive online. Its marketplace now offers millions of products, while its advertising business continues to grow rapidly, giving the company another high-margin business. For years, Walmart's business model was simple. The company bought products from suppliers, put them on store shelves, and earned a relatively small profit on each sale. But today, Walmart is increasingly making money without owning the inventory at all. One of the biggest changes has been the growth of Walmart Marketplace. Think of it like Amazon's marketplace. Instead of Walmart purchasing all the products, third-party sellers can list their product on the marketplace. When a customer places an order, Walmart takes a commission, charges sellers for fulfillment services, and if they use Walmart's logistic network, and often earn additional fees for storage and shipping. This model is attractive because Walmart doesn't have to invest capital into purchasing the inventory. That means low risk and a significantly higher margin. Over the past several years, Walmart has dramatically expanded the marketplace, growing its assortment from millions of products to hundreds of millions of products, giving customers far more choice than a traditional retail store could ever offer. This creates a powerful positive spiral. More sellers means more products means more customers. More customers encourage even more sellers to join the platform. The marketplace becomes more valuable as it grows. Let's talk about the growth drivers. There are 4 major reasons why investors are optimistic. First one, e-commerce. Online sales continue to grow faster than physical retail. Next to those sales, Walmart marketplace fees also bring a consistent new amount of revenue. Unlike several years ago, Walmart's e-commerce operations are becoming increasingly profitable thanks to automation and better logistics. But Walmart's most exciting business may not be retail at all. It could be advertising. Every time you search for a product on Walmart's website or app, companies want their product to appear first. Imagine searching for a protein powder or coffee. There might be dozens or even hundreds of different options. Brands are willing to pay Walmart to appear at the top of the research. These are called sponsored products, and they work like the ads you see on Amazon or Google. For Walmart, this is an incredibly profitable business. Selling groceries might generate operating margins of only a few percent. Digital advertising, however, often generates margins that are several times higher because the cost of displaying an advertisement is minimal once a platform is built. Which it is, obviously. Walmart is obviously a good company, but can it stay efficient in its costs? And can it stay efficient in innovating to find new revenue streams? How I answer that question is usually by looking at management. Walmart's management team has undergone a significant transition in 2025-2026, with a new CEO and a restructured executive leadership team focused on AI, digital commerce, and operational efficiency. John Furner became CEO in 2026, succeeding Doug McMillon. He joined Walmart in 1993 as a part-time associate and has held leadership roles across Walmart US, Sam's Clubs, and Walmart China. He is known for emphasizing omnichannel retail, AI adoption, supply chain modernization, and operational execution. Before I continue and look at the risks of Walmart, a quick disclaimer. Contact your financial advisor to check if this stock or any stock fits your portfolio. Do your own research, and past performance is not a warranty of future success. My name is Anne-Sophie, and I love everything personal finance. I want to help you get to a financially healthier place. Let me know your struggles, and I will do my best to address them. And want to know more about a specific stock? Please inspire me. So of course, Walmart isn't without its problem. The biggest concern right now for shareholders is the valuation. Historically, Walmart traded like a stable retailer. Today, investors assign it a much richer earnings multiple, reflecting expectations for sustained growth and margin expansion. But that creates risk. If earnings continue growing rapidly, everything looks fine. But if growth slows even slightly, the stock could disappoint despite the business performing well. Another challenge is margins. Retail is still a very low margin industry. Small increases in costs, from wages, transportation, or even tariffs, can significantly affect profitability. And finally, competition. It hasn't disappeared. Amazon remains dominant online, and Costco continues attracting loyal customers. Discount chains continue fighting aggressively on price. Walmart has advantages, but it still operates in one of the most competitive industries in the world. In other words, this isn't really a debate about Walmart's quality, it's a debate about how much of the new business is already accounted for in the stock price. To me, the pros of buying Walmart is a great company. It innovates in its revenue streams. It has a consistent cash flow. It is growing its digital business. And it is a safe investment, being the biggest and largest retailer in the world. Now let's run the numbers, my favorite part. I have made 2 scenarios. The first one is less optimistic. The stock price is already valued with the new revenue streams and therefore it doesn't grow that much, and it becomes slowly but surely a dividend stock. And then in the second scenario, I think of Walmart, not yet valued with the revenue diversification, so it has a consistent growth. So you can see in the first scenario, it doesn't grow that much in capital, but the dividends slowly increase with 50 cents a year, which is not bad, but it would take at least another 10 years before you can actually have fun with it as a dividend stock. And in the other scenario, I have taken a 10% growth, which is optimistic, but you never know, and the dividend almost doesn't grow. And there you can see a significant return on your investment. So here's my conclusion, whether to buy or skip Walmart. It depends on what you see for Walmart. Will the revenue from ads and marketplace increase? If you think so, then probably it's a good buy. Do you think Walmart will find new revenue streams? Then it's probably also a good buy. But if you think it has maximized and diversified its income as much as it can, then it is a safe investment, but it's not very good for your portfolio. And can Walmart keep the cost consistent? Well, we all know with the tariffs that can be hard. And so finally, if you're looking for dividends, Walmart almost doesn't pay dividends, and there are better stocks for that. Thank you so much for watching. If you have any suggestions or are interested in a different stock, please let me know, inspire me, and I'll come back to you with a short, quick, and simple explanation. Thank you so much. See you next time.